afternoon, Bapak and Ibu. Welcome to Colliers Indonesia live webinar. First, let me introduce myself. My name is Yulia Miranti. I am the head of marketing and communications for Colliers International Indonesia. I will be responsible for hosting this webinar. Let me introduce you today to our speakers. First of all, we have our Managing Director, Mike Broomell, and he will give his opening speech and a short comments on Indonesia property market. Followed by our Head of Research, Bapak Ferry Salanto, who will give his short 2020 recap and 2021 forecast on Indonesia property landscape. Next, we have our Head of Capital Markets, Bapak Steve Atherton, together with our Head of Advisory Services, Ibu Monica Koesnovagrill, that will explain about property investment opportunities in 2021. We also have our Head of Office Services, Bapak Bagus Adikusumo, that will present office property market opportunities. Our Head of Industrial and Logistics Services, Bapak Rivan Munansa, that will explain about industrial and logistics market opportunities, as well as our Head of Retail Services, Bapak Halsema, that will explain about the retail market opportunities. First, a few notes about our presentation. The audio and video for webinar participants are being disabled. This webinar is being recorded, and we will share the recorded file and presentation slides tomorrow morning to your email inbox. We will also have a Q&A session at the end of the webinar, so please feel free to type your question in the question box below. And if you need any help with the webinar, please type your question in the chat box. So without further ado, please welcome our Managing Director, Mr. Mike Broomell. Pak Mike, the floor is yours.
Okay, thank you, Auntie. As Auntie said, my name is Mike Broomell. I'm the Managing Director for Colliers Indonesia. And just wanted to say a few words, but first of all, I'd like to welcome many of you. As I've looked at the people that have signed up for the webinar, I see many friends and business associates, and some of which I haven't seen in quite a while. So it's great to have you here. A reminder that the discussion today is focused on developers and investors and looking at it from the perspective of developers and investors. We have another webinar tomorrow looking at the property market from the standpoint of the occupants of the property. For those that know me, I've been in Indonesia now for 28 years. I moved here in 1992. And I would say this last year has been probably the second most difficult in the property market that I've seen. The worst, of course, was 1998. And this is close behind. And unfortunately, I think we haven't perhaps seen the worst of it. We may see it get even more difficult in the first half of 2021. One of the good things this year, of course, is the passing of the omnibus law on job creation. And I think that's will help to eliminate or minimize, I should say, some of the difficulties in the property market here. We're going to, of course, look at different asset classes today. And the reason for that is because the property market is different depending on what kind of asset class we're talking about. The asset class that we look at that's been hit the hardest would be the hospitality market. Hotels and resorts, of course, have been put in a very bad situation, both with occupancy and with rates. Hopefully, though, they'll be recovering, at least the ones in the resort locations, once the vaccine is available. But until then, I think it's going to be a pretty tough sledding for such owners of hotels. But it is a good time for investors. And if any of you are investors, as you may know, there is quite an interest in buying hotels and resorts in places like Bali. But there don't seem to be many transactions occurring at the present time because the people that already own hotels and resorts are not that interested in selling for such a discounted price. Retail would probably be the next hardest hit over this last year. The occupancy may look good if you walk into many malls, and it seems like the traffic has picked up. But in talking with many developers, it appears that many of the tenants are not able to pay rent, or they're paying discounted rent right now. But the shopping mall owners are in a difficult position because they need to keep the mall full. So it doesn't look as bad as it probably is. Again, it's a good market for investors if there are developers that need to sell and want to sell. And in some cases, we're seeing opportunities for developers too, in particular with standalone retail facilities. For office space, before COVID hit, occupancy was already poor and rents had already dropped. It hasn't gotten any better during this particular period of time. And we feel like the recovery may be somewhat slow because a lot of tenants right now are finding it somewhat uncertain as to whether they should keep the amount of space they have or reduce the space, because a number of folks have been working from home, and it seems like a lot of employers and employees are finding the work from home situation fairly attractive. So again, office might be a good long-term play, but perhaps in the short term, it's going to be tough unless the office space is near TOD sites along the MRT, for example. Apartments, take-up was slow before COVID. It's even worse at the present time. It's tough to be an apartment developer right now, trying to dispose of the units that you've already developed. Landed housing was strong before COVID, and now with work from home, it's even stronger. So we feel like and see an interest on the part of a number of investors in developing, especially in joint ventures with local property and landowners. Industrial logistics, again, it was very good before COVID, and with the work from home, e-commerce is certainly benefiting. The logistics market is great. Data centers also are in high demand. So we see many opportunities for developers and investors. Now, my colleagues will be talking in more detail about each of these asset classes in a second. And before each of them speak, Ferry Salanto, who heads our research department, Ferry is going to be describing a little bit about that particular asset class and the market that we've witnessed over the last year. So thank you very much for joining us, and we look forward to further communication even after the webinar is over. Bye.
Thank you, Pak Mike. Thank you for the opening speech. So we'll move along to the first asset class, which is office market opportunities. As mentioned by Pak Mike, the presentation will begin with Pak Ferry Salanto, who is our head of research, explaining about the market in 2020, just a recap, and also the forecast for 2021. And then Bapak Bagus Adikusumo, who's the head of office services, will then explain about the property opportunities. So Pak Ferry and Pak Bagus, the floor is yours.
Thank you, Auntie, for the chance to give me time to speak, and also thanks to Mike for the introduction. So here I'm going to present you about the office market situation. I would like to update you with what has been happening with the property market situation along 2020. Again, this is only the recap of what we have been through for almost 1 year. For sure, we have seen from the market, what we have seen from the market is the slowdown in the construction activities. You can see the slide here. And then, but basically it does not entirely hold the completion time. So far, building under construction is still progressing as scheduled, especially those that are in the finishing stage. Only that it is in a slower pace. That's what we see, including the fit-out activity from the tenants. If you look at the chart below, you might notice that the our rent projection is somewhat flat next year. There is some adjustment made by a few buildings in their offering rental tariff, but it doesn't change the overall rental calculation because so it doesn't really imply in the chart. But overall, we have noticed a quite substantial discount from offering rent to transaction rent, which is higher than in the normal time. Next slide, please. So we see that next year will remain a challenging time for office industry, particularly for the landlords. It's a tenants market situation that will continue on next year, making it more competitive. Not to mention a big amount of office space scheduled for completion next year. But over time, we think most landlords are becoming quite alert with the concern of oversupply pipeline. As you can see from 2022 onward, supply projection will become very moderate. So along with the hope for better GDP projection going forward, this will help counterbalance between supply and demand. Our occupancy projection for 2021 might not look good for office landlord, again, because we are still anticipating a bigger amount of office space next year, and that the market will need some time to recover, especially looking from the tenant side, which might seek for efficiency when deciding to expand their operation. This is also related to the work from home policy that is felt to be quite effective and might become solution for tenants to cut their operational expenses. Again, despite the slowdown in the office business, my colleague Pak Bagus will elaborate opportunity during the hardship. Pak Bagus, over to you.
Thank you, Ferry. Thank you everyone for joining this webinar. This slide, I'd like to show you the brief summary of office market for the last 23 years. Prior to 1998 Asian financial crisis, actually office market was doing well. Back then, rental rate were all charged in US dollars, and the actual base rent for grade A or premium building achieved $22 to $27 per square meter per month. Service charge $6 to $7 per square meter per month. And then Asian financial crisis hit 1998, where the rupiah went up from 2,000 to 16,000. And then rental rate also has gone down to a record low, hence the market becoming tenants market. So starting with developer landlords market and becoming tenants market. And an office market stays soft and challenging for 6 to 7 years. And then we had 2008 global financial crisis. And then at the time, Indonesia market was resilient. So the impact wasn't so big. And then booming office market in 2010 and 2014. At this time, majority building charged already in rupiah rate. And then market was booming, demand for office space is higher than supply. And then the actual base rent achieved for grade A and premium building is exceeded what it was in prior to 98 Asian financial crisis at 35 to 50 US dollars per square meter per month. This is the time where many developers, including foreign developers, decided to come to Jakarta, find a deal, and build new office buildings. And then we're hitting 2015, 2021. So all those developers that design and start building on a building, those buildings are completed in 2015 until 2021. However, office market started experiencing a decline in 2015. Bank Indonesia issue a regulation, rental rate has to be in rupiah. A lot of industry, oil and gas, plantation, business all went down. And then because of the lot of supply coming into the market, so 2015, 2021, we start seeing a new supply per year, 3,000 square meter per year. Well, it was in the past only 120 to 140,000 square meter per year. So office market from 16 until now is oversupplied and back into a tenants market. And rental rate right now, we're facing a drop from where it was in 2010 and 2014. So next slide, please. The question is, what do landlords or sellers need to do and what are the opportunities? From the leasing perspective, understanding the current market, landlords are advised to be flexible and accommodative to the tenant's needs. Rental rates should be flexible. Flexible in a sense that tenant in general, they would like to pay market rent. So has to be considered supply and demand, building location, age of the building, green building, raised floors, and all the other matters incorporated in order to get a market rent. And then right now, it is also advisable that developers or landlord focus more on increasing the occupancy rate to a level of around 70%. Because when the developers achieve 70%, the service charge received from the tenant is enough to cover 100% of operation costs. So that has to be achieved as quickly as possible. Then once you achieve 70%, then you start increasing the rent in order to take up from what was sacrificed in the previous occupancy rate. And also landlords should consider providing fit-out allowance. In the past, when companies trying to move, they go to make a business case to the headquarters sitting in Europe, America, or maybe Hong Kong, asking for the fit-out capex. But now global COVID-19 pandemic is global. So they're having problems too. So it's not easy to get fit-out allowance. So it is also considered for the landlord to consider providing this fit-out allowance so that companies could move. And the landlords will also proactively approaching the existing tenants to renew their lease. Tenants in general, if the landlord approach and it becoming transparent, in general, they just want to pay market rent. And if they're happy where they are, they normally just renew the lease and pay the the rent that is already reflecting the market. Now, from the strata title perspective, this is the sale of the office space. It's currently oversupply, so the value of the strata title is also corrected. So if developer sellers would like to sell, has to be flexible with the pricing strategy. And also in the past, many developers, many investor bought strata title space and they would like to sell it again, get capital gain, or they would like to rent it at a good return. Now it is quite challenging. So what they do is they lease it at a very, very competitive rent, consider low rent, because in order to be able to get the tenant has to be very competitive right now. And then because the tenants comes in, they don't have to pay the service charge. So by having the tenants, the investor doesn't have to pay the service charge. And what are the opportunities for the developers? Developers with strong cash flow right now have an option actually to buy good income producing properties or even land bank at a discounted price. Developers could also take over the projects that are facing difficulty in completion at a good price. We've seen that happening. And then for the end users, there's an opportunity to buy a whole building or a major portion of the strata title space. Next. Now, working from home policy. Because of COVID-19 pandemic, everyone here forced to work from home. Whether you like it or not, you cannot go back to the office because of government issue a large scale of restrictions. So we have to work from home. Now, the impact of working from home after 9-10 months. So now makes the companies consider reducing the amount of space needed to when they renew their lease. So we have seen in the market companies when they renew their lease, they try to have the option to reduce 10, 20, up to 30%. Even some companies already decided to reduce up to 20%. And then also working from home will most likely continue to be applied in the future. So we've seen companies already set and then decided to have a policy that the working from home policy maybe will be continue like at least once a week, or if not more, twice a week. And then more and more companies right now trying to redesign their office layout to become more collaborative, more open. So less and less of closed office. So that way they don't really have to need a lot of office space. In terms of the possibility of renew or relocate, due to business uncertainty right now in the market, many companies in general consider more to stay at their current building than moving to a new building. unless they have compelling reason. Now, this compelling reason could be good new building offering a very attractive rental rate, and then the current building owners still charging very high rent, not reflecting to the market rent. So those are the situations where one of the companies could consider moving, and any other compelling reasons. Next, please. Now, work from home from the landlord's perspective. Now, COVID-19 pandemic and also working from home, cause people try to find ways to reduce costs, right? And then they work from home, and then they rent the office space. The office space is empty, but they still have to pay rent based on the contract. Now, if their companies are significantly impacted by COVID-19 pandemic, they have no choice. They go back to the landlord asking for understanding and renegotiation. Some are successful, some are not. In the long run, when tenants renew their lease, working from home policy makes them require less space. So it will be more challenging in the future also for the landlord to secure tenancies. So a combination of oversupply market, COVID-19 pandemic, and also working from policy, landlords will take longer time to fill up the space. And then it is advisable landlords to focus more on approaching a more resilient company to the pandemic. Next slide, please. So now there is still lights at the end of the tunnel. We have vaccine and we have omnibus law, right? So vaccine is already found and countries already applying and distributing the injection of the vaccine. Indonesia is going to follow suit because the vaccine is already here and being processed right now. So hopefully first quarter next year, or early second quarter, vaccine will be distributed to the people. So vaccine is expected to help the economy grow again. Company will start hiring more people, sales performance will go back to the pre-COVID, and therefore office space will be needed, and expansion is also needed. And as economy grow, and then demand will catch up with the supply, because if you see the Pak Ferry slide, the supply will stop in 2022. So no more new supply 23, no more new supply 24, while demand continue to project. So demand will catch up with supply, and then actual rent in few years will then go up. The same with omnibus law, as Mike has mentioned. So foreign investment will improve and demand for office space will follow suit. And then we're hoping that with demand for office space is growing, catching up with supply and demand will balance out, and the actual room will go up to where it was in the next few years in 2010 and 2014. Thank you everyone for listening. I'll hand it back to Andy.
Thank you, Pak Bagus, and thank you, Pak Ferry, for the presentation. So move along to the next asset class. This one is for retail. So we will have Pak Ferry again explaining about the retail market in 2020 and 2021 forecast. And afterwards, we will have Bapak Sander Halsema as the head of retail services to explain about the retail market opportunities. Pak Ferry again, and Sander, the floor is yours.
Thank you, Auntie, for the chance again. So everyone, in terms of the supply, we can see that the amount of retail space coming in this year is quite significant. It is a point of no return for developer because all projects scheduled this year are generally in the final stage. So this has been a tough situation for both landlords and retailers. They have been using all methods and channel of integration between both online and offline during the pandemic. There is a time where sales gradually improved previously, but tightening of physical distancing, or PSBB, once again, give more pressure on retail business because restriction and limitation will greatly affect the number of customers. Small business need traffic and crowd for sure. So total additional retail supply in Jakarta and the greater area will potentially continue to grow in 2022 to 2024. However, most of the mall projects that are estimated to fall within the time frame are still in the planning stage. With the effect of the current pandemic, landlord will likely be waiting for the right moment to kick off construction. Even amid the pandemic, policies in providing rental discount are generally avoided by the landlord. But the most important thing is to help tenants cash flow, such as delaying the lease payment or down payment or security deposit. Some landlords, what we see, began to mitigate rent to provide a win-win solution. However, this policy will depend on the landlord financial capabilities and will be applied differently for each of the tenants. Next slide, please. Okay, we basically anticipate that Indonesian GDP will contract minus 2.7% at the end of 2020. This slowdown in the economy will likely weaken purchasing power. The impact was felt by some big retailers such as department store, home furnishing stores, and big retailer groups that reported experiencing a drastic decrease in income. And we also see that some stores permanently close and decrease their occupancy rate. So far we see that COVID-19 has become catalyst basically for using online media and technology in retail business. Because we see that various sales channels have also been utilized, and one of them is virtual shopping. However, experience will always be the main attraction for people coming to the malls. In the future, I think the main purpose of people coming to the mall is to gather and interact. So a neat collaboration between landlord and tenants is required. Landlord, in this case, should accommodate this by paying attention to the tenancy mix. Then tenants should also refresh the store layout and provide more space for a customer to have to gather or to chat with each other. I think that's all from me. Over to Pak Sander.
So, hello everybody. Good afternoon. Thank you again for dialing in this webinar. Before I want to look ahead, I just want to give a short summary of what has happened in 2020 in the retail market. And unlike the Netherlands, for example, where there's a complete lockdown right now, Indonesia never really adopted a full lockdown, but rather what's called large-scale restrictions or PSBB periods. And in Jakarta, the first PSBB period commenced on April 10, was extended a couple of times until 4 June. And then a second PSBB period was reapplied from 14 September until October 11. So during the PSBB periods, most malls, restaurants, bars, and clubs were closed down. And currently, on top of the PSBB periods that we had, Indonesia is in the middle of a recession. And this obviously has a negative impact on consumer confidence, which in Indonesia is far below 100, indicating pessimism among consumers. So most of you know, and you will understand that it has been a very tough year for both retailers, retail landlords, and developers. And if you look at retailers, for example, a lot of in-store employees have been laid off, but also people working at the offices. So it's been tough. Now, if we look at an initial response from the retailer side, retailers have really conducted portfolio reviews, looking at the performance and the locations of outlets to decide whether they should close them permanently, if possible, of course, or to keep them open. And they've also become much more conservative in their expansion. So they're planning to open less stores than they would normally do. And if they open, they might look for less square meters, demand lower down payments. We've heard from retailers and work with retailers that are asking for 10% down payments, while in a normal situation, that would be around 20%. Lower rental payments at the beginning of a lease term, which will be compensated later on during the term. And so retailers are really using these things to try to minimize the burden on their cash flow. Apart from that, we've also seen retailers that have increased their effort to, like Ferry also said, to create and improve their omni-channel strategies, looking for cooperations with digital platforms like Shopee, like Happy Fresh and Tokopedia. And examples of retailers are Hypermarket and Matahari. And there's many, apart from that, there's many F&B retailers, but also fashion retailers that have joined forces with the likes of Gojek and Grab all obviously in an effort to increase the sales during the pandemic, but also after the pandemic. Now, if we look at the landlord sides, on the other hand, like Mike also said earlier on, they had difficulties collecting rent from tenants in the past several months. Obviously, for landlords, it's critically important to maintain a strong tenancy mix, and so landlords have been relatively flexible towards their tenants. We've seen at the first initial pay-by-pay period, we've seen free rents at some malls for selected tenants until August. At the second pay-by-pay period, we have seen rental rebates between 30 up to 70% for selected tenants. And landlords have been more flexible, especially towards F&B tenants, on the service charge payments, which some landlords are really charging only based on usage. And then, like Ferry said, new projects came onto the market, and there's a couple of projects that are about to be finalized. And those developers or owners have experienced difficulties having their signed up tenants doing their fit out, since you can imagine a lot of retailers have major cash flow issues at the moment. And so they cannot afford to use their capital for fit out purposes. So some malls decided to open up at a much lower occupancy rate as they would normally do, which in my opinion, I guess has been a wise decision, as it's still so hard to predict what's going to happen on the short medium term. And so by opening those malls, at least consumers can go there, and retailers, also the ones that haven't opened up yet, can have a sense of the footfall and experience the atmosphere in the mall. And so it's probably been wise just to open up, even though the occupancy is low. Next slide. So I guess we're kind of on a path to recovery. I think things look more positive as malls are allowed to operate again, and more people go back to their offices. Restaurants right now, they can operate at a 50% occupancy, and what I've seen in different areas in Jakarta, they're actually operating at a higher percentage. And cinemas, they can operate at 25% or 50% in some other areas. I want to highlight cinema operators. I've been talking to a few over the last couple of weeks, and for them it will remain to be tough towards the end of the year, but also in the beginning of next year, as it's hard for them to make profits, obviously, at such a low occupancy. And they're also not allowed to sell any F&B items in the cinema. And on top of that, there's less new movies coming out, so it's hard for them to get good content, which obviously attract visitors. So with a low ticket sales, no F&B sales, consumers also reluctant to go to a cinema, and then very little new movies. I think those operators will keep on struggling until things really turn back to normal. So if we look at malls, I guess it took some time for them to get back to acceptable footfall levels. But now it seems, at least to me, that in the weekends, it's almost back to normal. And with F&B being allowed to operate again, also during the weeks in the evening, the footfall levels are acceptable, I would say. We had a regional call with all the retail heads of Colliers in Southeast Asia and Australia, and what stood out for us really is that once things are opening up in a country, F&B retail is really recovering very fast. I guess because people really have the need to hang out with their friends and their family, and so that's a good sign, I would say. Next slide. So if we look at next year, and the things that will influence the retail market, I would say one of the things is, of course, e-commerce. I already said that a lot of retailers developing both direct channels as partnerships with third parties to try to increase the sales and compensate the sales that they're losing basically in their physical stores. And so if you look at the last, let's say 2018-19, the e-commerce sales compared to the total sales, retail sales in Indonesia has been around 10%. And that obviously, because of the pandemic, has increased a lot. And with malls being closed and people working from home, you can imagine that a lot of people went online. And we've actually seen in Indonesia that the number of online shoppers grew from 75 million to 85 million right now in Indonesia. So an additional 10 million during the pandemic. And if we look ahead, we expect these shoppers really to remain to buy online after the pandemic as well. So segments that did well during the pandemic were really health, personal care, groceries, and fast-moving consumer goods. And what's also interesting and stood out for us is that retailers are using that sales data, that online sales data, to determine where to open their new outlets. And so where they would normally go to CBD area or busy office districts, they now know that there are people working at home, and so they're really looking at the sales data to open stores more at residential areas closer to where their consumers reside. So if we look at the expansion in stores, we expect to see an increase in interest at retailers for standalone sites or roadside stores with drive-through if they work in the F&B segment, and also closer to residential areas. We also expect to see changes in store design, and stores will also serve as fulfillment centers with designated areas for Gojek drivers to pick up orders without really having to interfere with the day-to-day retail operations and with consumers. So they will have a designated area to pick up items. As mentioned earlier in this presentation, we expect retailers to demand lower rents, or when we talk to them, they talk about co-feed prices. And also, we also expect retailers, if their concept allows them to take up less square meters. We might also see a potential increase in demand for revenue sharing contracts for better risk-reward sharing, risk sharing, especially I think for standalone locations. But retailers really are going to protect themselves for extended pay-by-pay period or even maybe new pandemics that are coming up. And so we expect higher demand for revenue sharing models. Now, the thing that is obviously going to be the most positive impact on the retail market is a vaccine. And we think that when a vaccine becomes widely available, confidence and positivity will return among retailers, among developers, and also among consumers. And I'm pretty sure that people really have the need to go out and meet again, and they will do that mainly in the malls here. And then after a certain time period, of course, the rents will get harder and might eventually go up as more people go shopping and the demand for retail space will increase. So that's a short overview of the retail market. Please reach out to me if you have any questions and want things clarified. Thank you very much.
Thank you, Sander, and Pak Ferry for the presentation. So we're going to move to another asset class, which is industrial and logistics. Again, Pak Ferry will explain about the 2020 market and 2021 forecast, along with Pak Rivan Munansa as the head of industrial and logistics services, who will explain about the market opportunities. Pak Ferry and Pak Rivan, the floor is yours.
Thank you again, Anti. Okay, this is the situation of the industrial market property along 2020. As you can see from the picture there, this is the distribution of industrial estate in the Greater Jakarta area. So basically during 2020, most of industrial developer, they are holding their expansion plan until the market situation recover. So there's no additional new industrial land being developed along the year. And much of this, many of these, the industrial landlord they are focusing on the internal consolidation, basically, and serve existing tenants. So far, what we see in the pie chart below that, automotive industry structure the most sales for this year, and this is not basically very normal, because for the last few years, automotive has not been very quite. It has not been so active. What we see, the active sector are basically coming from the logistic and warehouse, but there are some demand in the pipeline for logistic and warehouse sector. But the interesting to note that food are still making the most of the transaction during the whole year, we understand that this is the sector that are not very really being hit by the pandemic. And also, it is also interesting to note that we see that the data center activity are quite happening during the year. So about 13% of the total transaction this year are composed by data center. So again, in up to the third quarter of 2020, total sales are recorded only about 33% of the total sales of last year. So it's very minimum, meaning that only 118 hectares are being concluded this year. So we don't expect to see more sales happening at the end of 2020 or the fourth quarter this year, because I think the situation are still replicating what happening in the previous quarters. Next slide, please. Okay, again, in general, price has been corrected quite moderately this year. As you can see, most of the area are reducing their prices, but basically this is because of the adjustment made because of the exchange rate situation. So what we see that there will be no expansion in the south, but we are expecting to see more. One industrial estate will be within Sukabumi area, about 223, and then what we see that the annual sales per annum will be around less than 200 on average. So we expect to see that the price will remain unchanged. Only that the situation is getting better next year, hopefully, because we believe this industrial sector will be, I think that will be the first sector in the property business which will be recovered first compared to the other. Thank you. Back to Rivan. Over to Rivan, sorry.
Okay, thank you very much, Ferry, for the recap of the industrial property market in 2020. Regardless the world pandemic that hit many sectors, industrial is considered as one of the healthiest among others. In this presentation, I would like to highlight some of the opportunities from the perspective of the developers. The first one is the strategic planning. As you know, compare with the situation in 2020 to 2013, where the picking up of the industrial market is actually now is a good time for a developer to start looking for the property, either existing warehouse or factories or land at a strategic location. And probably now it's a good time to get a good price for that kind of property, as well as a developer, knowing the potential of the market, you can also start securing a land bank to be able to develop a future industrial estate. The second opportunity basically is the expand. As you see, the massive ongoing infrastructure development in Indonesia will make easier the connection between the cities and also the development of the port. That will not only limit the development in Bekasi, Karawang area or Greater Jakarta, but it's also other areas to be considered because of the government also supporting of the development of the infrastructure and all the ports. The third one is the possibility is, as you know, we are all going to the moving forward to the Industry 4.0, which is even though currently we are not there yet, but as a developer, in order to attract more tenants inside the industrial estate, you probably need to start developing an industrial estate that will apply this Industry 4.0. As we know, I mean, the original one probably we only hear about like industrial city, which is led by the demand in the market. And now some of the industrial estate move to the integrated and clustering type of industrial estate. And now it's already at the stage when they can claim it as a smart industrial estate. But it will, as a developer, we need to think about it to prepare for the future. At the time when we fully operate on the full Industry 4.0, it's full automated and AI based. The other one is Patimban Port. Is the development is encouraging right now. I saw the progress on site. I believe by beginning of next year, the port should be operate the first phase. This will attract some of the area in not only Bekasi and Kerawang, but also Subang area and some of the area, Purwakarta area, where also will be connected with the JAPEC 2. And the last one is the new development area in Central Java. Recently is very attractive because it's supporting by the government, the Kawasan Industri Terpadu Batang, which is the government realized that we need to compete with Vietnam, who already give a lot of good deals for investors. So lately, I saw a lot of labor-intensive type of industry that start shifting their operation to Central Java. So next. So during the pandemic, also as mentioned by Mike and my other colleague, e-commerce is growing very fast because of the pandemic. A lot of people changing their behavior, not going from offline to online. So e-commerce is really potential to grow in the future. Automotive is probably hit the most compared to other industry. However, currently it's starting to become better. But in the future, I think when the vaccine is there, the market is in recovery, then I think there's a potential for automotive to grow, which is from the engine type of automotive become hybrid and electric vehicle in the future. And we also see a lot, there is a potential growth on the cold storage because of the pandemic. I just see in the market that we see a big storage space coming into the market. There's a demand on that one. And then as well as data center, as mentioned before, a lot of big players already come into the market here and start building their facilities in Indonesia. And FMCG, at the beginning of the pandemic, I saw there's a slightly impact on FMCG, but right now is actually back to normal. And even I see a lot of FMCG start expanding in the market. And then, so as a developer, warehouse is very good. I mean, in terms of developing a warehouse, because the warehouse is really, there's a demand for the export-import type of customers, e-commerce, cold storage, and also manufacturers. All of them are in high demand currently. And then the last one is the opportunity of the fulfillment center, which is some of the retail building that is probably not doing well. in the market or other type of building during this pandemic situation condition, we should be open our eyes to look in the market for the availability of a building, which is we can switch to a fulfillment center. So because right now finding the property is especially for e-commerce that should be close to the high population people, that is quite challenging, as well as with the consider about the price, because if the property close to the high population, then the price of the property also is high. That's probably that's all of the opportunities that I look at it. If you have any question or any, you can email me and ask about the industrial. So I'll give it back to Anti. Thank you.
Thank you, Pak Rivan, for the presentation. Move along to the next asset class. It will be apartment and hotel market. Pak Ferry again will explain about the market updates, and also we will have Pak Steve Atherton explaining about the apartment and hotel opportunities. Pak Ferry and Pak Steve. Pak Ferry.
Thank you, Auntie. Okay, if you look at the chart here, this is the cumulative supply of apartment, and that's also online our projection up to 2024. So the number there in each of the bar imply to the number of apartment stock that is projected to come in that year. So if you look at the table below, that's explain the projection that we made in last year before the pandemic, and the reality of supply happening up to the third quarter 2020. So that's a big difference. So basically that implies the confidence level of developer in launching or introducing their new project to the market. So basically the total sales of apartment Antara Pampinol is only represented about basically 30% of last year total sales. So that's a huge drop in the sales of apartment in Jakarta alone. So we have seen very limited number of projects being handed over. So far, it's only like one project up to the third quarter. And what we see also, the absorption rate was stagnant at 87.7, which is still high. But if you look, if you break down the number, the performance or the sales performance of under construction project was a little bit drop compared to last year. So we also see that developers continue to maintain prices, but they basically giving more discount up to about 2 to 20% at the max with additional gimmick and promotion. There are some newly introduced projects during the quarter, but landlord decided to hold sales activity due to the sales performance. And also we see that rental tariff of service apartment has been dropped quite a bit, about 5% compared to last year. And from the expatriate market, with the current market slowing down, expatriate are having difficulties in entering the countries right now. But on the other hand, they are leaving the country due to the pandemic. So that's give consequences to the cancellation of the leasing of apartment and housing. Next slide. Okay, you see here, this is what we have been discussed earlier. So so far we see that the offline channels can be enacted again. Of course, that the large-scale restriction is not being activated again. And we expect that marketing galleries and so units are allowed to be open because that's very important for developers to continue selling. However, we see that sales performance has remained dull since the condition continue to be uncertain as the daily COVID-19 cases have been increasing and the economic growth plummeted. We see that potential customers have continued to adopt wait-and-see action, although currently it is still a market that favors buyers. So this uncertain condition create hurdles for developers too. We see that some developers have decided to hold back sales activity and construction progress on relatively newly introduced project. We see they have to focus on finishing their current project to survive during this time period. However, we believe after this pandemic ends, the economy will recover and so will the market. So in general, most of the tenants were short-stay renters from domestic staycation, holidays, since travel restriction still continue on, as well as the refusal of entries of foreigners has prevented of the return and arrival of expatriates. So at the end of 2020, we expect that this still be a challenging because of the traditional low season in the leasing market. Thank you, Andy. That's all from me.
Thank you, Pak Ferry. Pak Steve.
Thanks, Andy. And thank you, Ferry, for that overview. Good afternoon to everyone on this webinar, and thanks for joining us. With few exceptions, most recently completed apartment projects that did not already pre-sell the majority of its units would be facing a difficult market condition. Even before COVID, the apartment market was already soft for a couple of years. This covers from the low end of the market to the middle and upper end. Making matters even worse for the apartment market is the disappearance of the individual investor segment. They have retreated and are sitting on the sidelines for the most part. So the end user is the main target for buying apartments these days. Unless the product is located in a very strategic location or the unit size and total price is very affordable, we still see few takers. Also, the demand for renting empty apartments has not been large. This reflects the reduced foreigner market as well as the reduced demand for professionals to lease apartments near the workplace during COVID. However, one positive prospect for the apartment market is co-living or more institutionalized rental apartments, where there is sizable scale to the offering, say multiple floors or even a full tower. The offering is a lifestyle type product, including facilities, community areas, co-working, even you could say a type of culture. There are a few investors and developers looking to create these kinds of communities. Probably the biggest success story during COVID has been landed housing, especially for affordable housing priced under 1 billion rupiah. Throughout Greater Jakarta, we see larger landed developers successfully launching new clusters and experiencing healthy take-up at reasonable prices. It may not be 100% of pre-COVID take-up pace, but it's not bad. Even certain prime locations for middle and middle up landed housing priced in the 1.5 to 3 billion or more range have performed well. This might be revealing the broader preference still of landed homes over apartments, and the still relevant reality that as new families and households are formed, they need somewhere to live. And affordable landing housing is still a favorite, especially as townships and new clusters are located closer and within easier reach of an expanding toll road network and MRT, LRT, and commuter train lines. We've also observed that many foreign developers of offices and apartments have shifted their targets to landed housing. Recently, Sinar Mas Land announced a partnership with Midbana, a JV between Mitsubishi Corporation and Serbana Jurong to co-develop a new 100-hectare transit-oriented development in BSD. We also have other foreign developers entering the landed housing space, mostly through JVs, including Hong Kong Land, CFLD, Tokyo Land, Toyota Susho, Panasonic Homes, Nishitetsu, Mitsubishi Corporation, Hankyu Hanshin, and KQ Corporation. The hospitality industry has been one of the most affected during the COVID period. Between the government's domestic social distancing measures and the travel restrictions for foreigners, demand has been hit from both sides. While both hotel occupancies and room rates were already down in 2019 due to overbuilding, COVID has driven hotel occupancies down by 50% or more. Nonetheless, we do see some opportunities in hospitality. We are seeing some foreign hotel owners and operators strongly pushing ahead with acquisition targets in strategic beachfront locations like in Bali. Also, some foreign hotel brands are looking at large, growing middle class in Indonesia and are still pursuing market entry strategies during this COVID period. There are also some individual local investors seeking smaller hotel acquisitions in the 30 to 100 billion or even 200 billion range in Greater Jakarta and Tier 2 cities. However, for the most part, foreign and local hotel investors are seeking discounted COVID-priced assets. They want to see 30% or more discount from pre-COVID valuations based on 2019 performance. Next slide. So covering investments, to start with, I might as well say it like it is. Right now, most investors expect a COVID discount for buying any large ticket property. Even if you've been in negotiations starting before COVID, many investors will still be looking for a COVID price adjustment. The justification is that in order to preserve minimum expected profit margins, the future revenues will need to be reduced to reflect a slower U-shaped recovery, and therefore the cost of the land requires downward adjustment. Or for income producing assets, the time to fully lease the building or sell strata units will take longer, and the rents or prices and marketing incentives will need to be adjusted. Therefore, the price should reflect these considerations. For office, while the office sector is experiencing serious challenges, we believe that office will still be around and have a bounce back. Still, we don't see many Class A or premium office buildings offered at competitive yields. However, we are seeing a few cases of very strategic development sites near MRT stations and the like becoming available, and selected premium developers are willing to pay fair prices or enter new joint ventures. For retail, with one or two exceptions, we do not see much demand for constructing new malls in Greater Jakarta right now. And lastly, for industrial and logistics, many foreign investors would love to buy logistic facilities and data centers across Greater Jakarta, but the availability of assets for sale is very light. Most of the opportunities will be greenfield development projects. That's about all from capital markets and investment services. Thanks for your time today. And please feel free to reach out to me if you have any questions or if you have any new projects for us to work on together. Thank you.
Thank you, Pak Steve, for the presentation. Now we'll move along to the presentation from our Head of Advisory Services, Ibu Monica Koesnovagrill. Ibu Monica, the floor is yours.
Thank you, Auntie. As the last speaker, I will try to summarize what has been discussed earlier. The COVID-19 pandemic has dragged down Indonesia's economy quite badly, from 5% in 2019 to negative 5% in second quarter, before slightly recovered to negative 3.5% in third quarter. We did hear that its property sector was hit quite hard during 2020. However, we also heard that opportunity is still there, Investment in 2020 was still moving up both for foreign and domestic investment. Yet investment was relied more and more to domestic investment. So as at third quarter, the ratio between domestic and foreign was 51 to 49. During this hard time, a project is exposed to market and investment risks. In being able to cope with investment risks, collaboration become one solution. Different types of collaboration could be applied: GV, land lease, BOT, or master lease. By having GV, developer could share both investment and market risks. By adopting BOT or land lease, one developer could overcome the difficulties of acquiring proper land size, whilst the landowner could get their land being developed. A master lease concept could also become a solution to mitigate market risk. Next slide, please. Okay, limited demand, lifestyle change, disruption, generate needs market for what I refer as product derivatives from the traditional property products. When COVID-19 made people being reluctant to work in traditional office space, it generated demand for flexibility working place or smart office space. Then when people avoid gathering in crowd and stay away from shopping center, it generated demand for cloud kitchen. With work from home become new working style, logistics center, including fulfillment center, data center, cold storage, landed houses, became more and more demanded. Logistics stock in Greater Jakarta was growing by 3 to 4% per annum, whilst demand was actually growing higher by 6 to 8% per annum. Development of logistics center has also started to emerge in other major cities in Indonesia: Greater Semarang, Greater Surabaya, Medan, Makassar, etc. Further, with limited buying power, yet with high percentage of productive age, demand for affordable accommodation is emerged, including co-living, hotel capsule, daily rented apartment, or even dormitory. And a project developed as part of TOD would also become an answer to an efficient lifestyle. Massive infrastructure developments triggered off TODs along MRT, LRT, commuter line, high-speed train, etc. All these products could be just for short-term trend, but also become long-lasting demanded products. Thank you from me, Auntie. Back to you.
Thank you, Bu Monica, for the presentation. That will conclude our presentation for today. But we'll still have a question and answer. We've received quite a few questions from the audience. To make it short, I will try to cram a few questions according to asset class. We will start with the office market and opportunities question. So Pak Bagus, if you can, maybe, okay. Hi, Pak Bagus. So we have a few questions, and I will try to cram this question so we can answer it in one go. I received question from Bapak Ahmad Maki, Bapak Geraldi Pradana, Bapak Wibowo Nugroho. So basically, they question, considering the oversupply and also the pandemic and the work from home policy, does Colliers have a conjecture about how much the new normal rate will be given yield compression has no room to drop? That's first. And then second, the most asked question about co-working space. How is the demand and what is the future for the co-working space? Pak Bagus.
Okay, thank you, Auntie, and thank you for the questions. As I mentioned early on, the office market is oversupplied, right? So the rental is currently being corrected, and depending on the developers themselves, the owner of the buildings, if they build the building on with loan from the bank, then they will have to have some kind of a bottom bottom rent that they have to agree with the bank. On the other hand, when the developers build the building on 100% equity, then they have that this particular owner have their own freedom. So answering to your questions, currently the yield, I think you're talking about yield, yeah. The yield in the office market in a normal time is 6 to 8%. So we've seen right now in the market some of the one or two developers having loan situation in their properties where they are willing to provide a good discounted price. So using that as an example, and then the property where they are right now, I cannot give you the specific example, but where the property they are now, the rental that is going to be used as a basis to calculate the rent, to calculate the yield, will be down by about 20% than where it was. So to answer to your question, is the new normal rent will be there will no more room to drop, is this particular example is 20% lower than the actual market rent prior to COVID. Whether or not it will go lower, it will depend so much on the situation of their loan situation with the bank. Okay, and then the second question is about co-working space. Now, co-working space has been actually heavily impacted by the COVID-19 and working from home policy. Most of their clients, right, in general, has been startup companies, and startup companies are pretty much impacted so much by COVID-19, and some of them, most of them are now closing down. So they don't need to take up as big a space as before in the co-working space. And co-working space actually has been the major occupiers of office space for the last 3 to 4 years. Now with this happening, so co-working space that has already been renting so many spaces, a lot of renegotiation right now going on between the co-working space operator and the developers. So the future of co-working space will depend so much on the ability of the vaccine and then the growth of the economy to come back into normal, and then they will have to find their optimum size of co-working space branch in order to be able to perform better in the next few years. And then the other thing that you mentioned also, the F&B and co-working space has been working together basically. So where there is a F&B, there is a co-working space. It's a good combination and good business model so far. But again, co-working space is having their own challenges right now because of the COVID-19 pandemic, where startup companies are having difficulty to survive. I hope that answered the questions.
Thank you, Pak Bagus. We have a few questions about office, but I think we will move to an industrial first. And don't worry, we will basically summarize all of the questions, and we will have Pak Bagus and the other panelists to answer via email if we cannot cover it today. So thank you, Pak Bagus. We'll move along to Pak Rivan for the industrial and logistic questions. Pak Rivan, we receive a few questions about the industrial and logistics. The first one is, with the completion of JOR 2, do you see any new areas emerging for logistics and industrial warehousing? And also, how about the East Java? Is there any lucrative market for East Java? And the potential area other than Surabaya, Pak Rivan?
Yeah, thank you, Auntie. Of course, talking about JOR 2, that's very good news for logistics, because currently the location is only rely on the JOR 1, which is everyone from Bekasi and Karawang will go through JOR 1 to Seaport, Tanjung Priok. So with the second JOR, that will help a lot for the logistics. So the area that along from Cibitung goes to Marunda area, the area will be potential for logistics, because then that will be good, for warehousing to serve either import and export, as well as to serve the manufacturers, which is located in Cibitung, Bekasi, Cikarang, Karawang area, as well as the connectivity. Another one going south, which is from Cibitung to Cijago, Depok. That's also a potential. We already start seeing some of the players, they buy land over there and build a warehouse, because that's good to serve the e-commerce type of clients that can cover Bekasi and Depok area, and also the connectivity to go in to the city of Jakarta. And talking about East Java, of course, usually the first facility will be set up in Greater Jakarta, but later on, Surabaya will be the option. And the area could go to the north, which is the Gresik area, as well as going to the south area for a new development of the industrial estate. Of course, there is a Lapindo on the south part, which is somehow impact a little bit on the development of the industrial estate on the south part of Surabaya. As other area or cities, we haven't seen. Right now, we are only focused on Bekasi, Karawang, and also Surabaya as the second biggest city. But in the future, probably we can see, like Medan, there will be a new seaport that will be built over there, and with the connectivity of the infrastructure, that will be also a potential for the development of new industrial area as well as others. I think that's from me, Anti. Thank you.
One more question, Pak Rivan. There's quite a few questions about industrial and logistics. So Pak Joseph Lukito give us a question. So he referred to what you mentioned about the industrial land correction, and that now is the best time to buy. Could you please maybe elaborate how much Corona price in prime industrial estate for logistic facilities, or how is the yield? Thank you, Pak.
Yeah, usually the typical one is during the good industrial market condition, the price will be dropped maybe like around 5% to 10%. But in the current situation, it depends on the seller, which is some of it could be, some even we start seeing some developer also adjusting their price down, as mentioned by Ferry. But I would say maybe around 20 to even maybe more than, could be some of it could be 30%. It depends on the from the seller. When they are very motivated and under distress asset, they may go for more discount on the price. As the yield is always difficult to know here because of the data availability in the market, but I would say before we're talking about 7%, but currently because of the risk, some of it they increase it to even 9%. I think that's about it, Anti. Thank you.
Okay, Pak. Last one, because so many questions about the investment and logistic. I think one of the question is about whether what is the clear land court process? Do we expect there's a clear land court process for this, Pak?
Sorry, can you say it again? Clear?
Can we expect a clear land court process and valid ownership in terms of industrial land?
Well, that's always a challenge for a big developer to when it comes to acquiring a land. So based on my experience, usually the foreign will work together with the local partner here who already understand about the process of a land acquisition in Indonesia. Otherwise, they will be, a lot of surprise to them, and then to go through the bureaucratic and long process in Indonesia. Yeah.
Okay, Pak.
I think that's from me. Yeah.
Okay. Last question. What are Pak Teddy Chandra asked? What are the typical ranges of investment size for industrial, warehouses, and data centers in the top 3 areas mentioned in the slide, including the respective potential leads?
Well, that's difficult to answer because it will be varied. Could go 10 hectares, 15 hectares, 5 hectares. It depends on the investment. If you're talking about Bekasi and Karawang, that's probably the minimum size, 5 hectares above, for the investment in for the industrial, as well as data center. Yeah. Okay, Andy.
Okay, maybe you can add the answer.
Already, Andy.
Okay.
Yeah.
Thank you, Pak Rivan. Now,
thank you, Andy.
So we will move along to Ibu Monica and Pak Steve Atherton for the capital market. Oh, but before, maybe we can jump into retail first. We received a few questions for retail. Pak Ferry and Sander, so there's a question from Pak Irwanto Rasad. Pak Ferry, how is the prospect of launching new shopping mall in Bekasi in 2021? How will the market react? Yes, Pak Ferry. Yeah.
Okay. Hi, Pak Irwan. Long time no see, Pak Irwan. I know Pak Irwan. Basically, it's not specifically in Bekasi, but in general area that we cover. I think the challenge is the same. We basically, if you have no other time to hold your plan to launch your product, then you should do it. But the challenge is that during this, we don't know whether the pandemic will be over in 2021. So the challenge will be the traffic that you expected is not as high as you are expecting. So I think that's the one of the concern that you should pay attention. Maybe Pak Sandro can add on it.
And I think in general for malls, I mean, but that's after things get better and after we are past this pandemic, you might see in the future that, and the mall operators that are joining the call know better than me, but you need to stay relevant with your tenancy mix. And so the reason why people come to shopping malls might change a little bit. I mean, people are really looking for experiences. And so you might see a larger percentage of F&B tenants and other experience tenants in the mall. And also, if you look at millennials, for example, they might like more specialty stores and different kind of products and retailers that really focus on a certain, maybe environmental friendly product. So as a mall operator, I think you can definitely stay relevant as long as you keep a good eye on your tenancy mix and what's going on in the market and what consumers demand. And so, like I said, I think it's going towards more of an experience center where, and so, you know, the percentage of take up by F&B and other type of tenants might change a little bit in going forward.
Thank you, Sander. Another question for retail from Pak Geraldi Pradana. By having the conversion conventional into online retail, is planning commercial shop houses in residential development still significantly needed, or maybe just focus 90% in residential zone?
Well, I think in general, brick and mortar retail is still very much needed. And I don't think, but that's my personal opinion, e-commerce is not going to replace physical retail. And if you see what's happening and what has been happening over the years, I mean, pure e-commerce players, you see that they're starting to open up physical stores. Just Amazon as an example, Alibaba is developing malls in China. And so I've talked to many pure e-commerce players and people high up in those companies, and some of them even say, listen, e-commerce is actually a very bad business model, pure e-commerce, because you have a lot of logistic costs, all the prices are out in the open, and websites are competing with each other, so that puts a lot of pressure on the prices and the margins. Consumers expect you to send all the products for free to your house, and then they order 3 t-shirts in different sizes, they send 2 back and keep 1. And so in general, I think the retailers that will thrive and will survive have that omni-channel strategy. So they have physical stores, brick and mortar stores, and they have an e-commerce or online platform. And on top of that, they work together with third parties to sell their product and integrate those services. And you know, so you could go to a store and buy things, and then the retailers bringing it to your house, for example. There's a Nike store on 5th Avenue in New York that's doing that. Or you could buy stuff online and then go to the store to pick it up, and you would buy additional items. So it's really the integration that's very important for retailers, I think, to do well, and not necessarily e-commerce replacing physical retail, because in my opinion, that's never going to happen.
Thank you, Sander, for the answers. We're moving on to Pak Steve and Ibu Monica. So this is more into the development and investment. Ibu Monica, Pak Benny Santoso asked question about the opportunity for developer to develop commercial area after COVID, Ibu.
Okay, thank you. It always depends on the type of products, because when you mention about commercial area, it will cover everything actually. So it will really depend on what kind of product and what is the location, because currently with this slow situation, actually it's also already happening before the pandemic. So the market is quite tight. So it really depends on where is the location. Those location that is really like in close to the TOD, then also if you really develop like the affordable products, then it could be absorbed faster actually after the COVID, because the demand from this bulk of people, because 61% of people in Indonesia is actually the young generation, the productive ages, and they really need like housing, they need apartment and others. So that's why the affordable pricing is really actually the key issue. This is actually my answer, Auntie.
Thank you, Ibu. Pak Steve, Atherton, do you have anything to add?
Yeah, I would I would also say that there will be continued commercial development opportunities after COVID. I would pay close attention to location and proximity to transportation, like MRT, LRT, commuter train, and Transjakarta bus. It's going to be really important to offer convenience in terms of your location. And I would also try to get a better understanding of the demand side. You know, getting closer to your customers. Client surveys could help and be a strong indicator of what type of commercial products are needed. Also, more conservative underwriting in terms of pricing and take-up. And then I would say, lastly, I would pay more attention to considerations like design, creating open spaces, and use of technology, hands-free.
Okay, Pak Steve. On that note, though, Pak Rahman Danu Pradana asked about the TOD as a development concept. I think maybe we can also answer to his question. Since we depend on retail activity in the TOD area, unfortunately, retail is going slow in this pandemic. Can you give an example of property product combination that will be proper after this pandemic?
Monica, you want to go first?
Yes,
okay.
sure.
Auntie, do you mean for the TOD, right? The question?
Yes, correct, Bu.
Okay. Yes. Actually, for TOD, if it is a really proper size of the project, it doesn't have to be relied heavily on retail. Actually, retail could be the supporting facilities, but the main component could be apartment or housing. I mean that it is should be apartment because people like to stay, like Pak Steve said, that is close to the transportation facility because it is more efficient to them for to live. So it could be the major component could be apartment. But then if the location is really good, then you could also have office there because people would also like to live and work close by. And then retail is a supporting because still you still need retail, but as a supporting, not really like a main concept. So this is actually my answer, Auntie.
Okay, Bu, thank you. To conclude, because we already like 15, 20 minutes past our time, Ibu and Bapak, I will still have one more question, but if you need to contact our panelists here directly, you can see in your screen, there's a QR code. You just need to scan the QR codes and then you can save their email address and phone number if you need to contact them directly for specific matters. Last question, Pak Steve and Bu Monica and probably Pak Mike, if you can help answer these two questions from Pak Greg Puyanto. Is there any similarity between the situation in 2020, I think maybe regarding the pandemic, to the economic crisis in 1998 or 2008 related to the property prices? This is the same, I think we can also include Pak Manish Rajput question that Pak Manish gave to us before the webinar through the registration. Pak Manish asked about the cycle of 7 to 8 year cycle, and we see some more downturn before bull cycle start. Maybe Pak Steve or Pak Mike can help answering the question.
Sure, I'll pass it over to Mike first.
Okay, I would say that COVID this last year has thrown off any cyclicality of the property market. So I wouldn't see that. I think with regard to the difference between now and 1998, I think the big difference is the currency because there was a lot of debt in U.S. dollars. There was a lot of pricing in Indonesia in U.S. dollars. And then the Indonesian government has forced everything to switch over to IDR. And I think that has softened the blow that might have occurred otherwise. So I think that's good. And I'm glad the Indonesian government did that.
Okay, Pak Steve, anything to add? Or maybe Bu Monica? Thank you, Pak Mike.
I think I would just add this COVID situation compared to 2008 and 1998 created this, pandemic issue where governments forced social distancing. We couldn't go to our workplace, our office. We had to work from home. And they also required lots of retailers, food and beverage, restaurants to close. So it's just affected the whole world. pocketbooks of people losing jobs I think in a much bigger way, and also livelihood and survivability of retailers. So this one's gone really, really deep, and we got a vaccine coming out, and we hope we see the light at the end of the tunnel. But it's been a lot more complicated, a lot more uncertainty, I feel, compared to those other two serious setbacks.
But we can still see some opportunities out of it, right, Pak Steve and Pak Mike?
Yes.
Okay. Okay, I think that will conclude because we already around 30 minutes past our time now. Thank you for everyone who's joining us today. We will send the recorded version along with the presentation slides to your email inbox tomorrow morning. And again, if you feel the need to, I saw a few questions and said, can we call can we call the panelists directly? Of course you can. Just scan the QR codes in the screen for anyone or maybe everyone that you want to contact, and then you can contact them directly via email. We still have a few questions that we haven't had the chance to answer. We will compile all the questions. We will ask the panelists to answer it through email. So we will compile the question and send the answer to your email inbox also. So thank you for everyone who's joining today. And also thank you for all the panelists for the presentation. We'll hope to see you again probably next year with the different topics of webinar. But for now, stay safe and healthy, and good afternoon. Thank you, everyone.
Thank you.
Thank you.
Thank you everyone for attending.